Hey everybody, this is Pat Logue with Prudent Financial Planning. Today we're going to talk about student loans. So just a little bit about me and my company, Prudent Financial Planning. I'm a financial planner with a bit of a unique twist. I work with young professionals who have student loan debt. I'm a certified financial planner as well as a certified student loan professional. In order to be a CSLP, you have to have at least 2 years experience in financial planning. You must be a licensed professional in their educational and coursework and exams to pass as well to be a CSLP. This designation just started last year, so that it's pretty recent. There aren't a ton of CSLPs out there yet, but I do encourage you, if you have student loans, to reach out to a certified student loan professional to get your questions answered by a diligent professional. So student loan debt, let's start with where are we? How did we get here? So we have 1.6 trillion in student loan debt here in the United States now. There are 44 million Americans that have student loans. So that's about 7 out of 10 graduates that have some form of student loan debt. And if we're talking about an average amount, it's about $30,000 per borrower. Many borrowers have $100,000 or more, 200,000, 500,000. I've seen up to $1 million. So don't feel like you have a debt that's too staggering or too small to get help with. Everybody could use a review of your student loans and check to see there just might be a way for you to pay off your loans quicker or save some money. So keep paying attention here. I hope you gain something valuable out of this webinar. When we look at options for our student loans, what can we do? What options do we have available to us? So the first solution is you can just call your loan servicer. If you have federal student loans, call your loan servicer and just take their word for it. They'll tell you what repayment plan they think is best for you, and you go from there. You can also look at the various lawsuits that have been filed against the different servicers for various reasons. I won't get into all of that, but I'll just say that that may not be your best solution. Second solution is what you're doing right here. Watch a webinar, DIY it, do it yourself, get some information, figure out if you can handle this yourself, or if you need solution number 3, you need additional help. You can reach out to someone like myself or another certified student loan professional to unravel the mysteries of student loan debt. The timing of this, why would you act now? Why is this so important to learn this at this particular moment? Well, first of all, we're in a period of $0 payment, 0% interest. That mandatory deferment right now is going on until the end of January 2022. Payments are set to resume February 1st, 2022. That could be extended. Again, we don't have any word on that yet, but we do pay attention to the latest breaking news on student loans, which I guess sounds kind of boring to some people, but that's where I'm at. Welcome to my life. I really enjoy helping people with this because it is has such a big impact on so many other areas of your life. But you want to look at loan forgiveness. You want to be working towards that as quick as possible. If that's something you want to do, you don't want to wait to figure out if that's the most beneficial idea. You also have to look at taxation. If you do work towards student loan forgiveness, will your forgiveness be taxable? That's something we're going to have a conversation about here. And cost, can you reduce your monthly payments and maybe at the same time, or reduce the total cost of your loans? So these are all important questions. It's a good time to look at this now. As far as loan forgiveness, we're going to touch on a few different things here, but we'll look at the various repayment plans, what's out there, and what forgiveness really means. When we're talking about income driven repayment plans, so that's a generic term. There are 5 different income driven repayment plans. People get this confused sometimes. They throw out some of these terms as the general terms, but IDR, income driven repayment plan, is the overall generic term. The 5 plans within that are ICR, which is income contingent. There's income-based repayment. There's a new income-based repayment. There's pay-as-you-earn, and there's also revised pay-as-you-earn. So there are 5 different plans. I'm not going to give you all the specifics of every plan. I'll give you just a brief overview of these so you have an idea of where you're at and what you're looking to accomplish. When we talk about ICR, this is the most expensive plan. This payment is based on 20% of your discretionary income. We'll go through some calculations to see what that means. And you only get a deduction for 100% of the poverty level. Moving up next to the next best plan would be IBR. Payment is based on 15% of discretionary income, and you get a larger deduction for 150% of the poverty level. So as you can see, it got a little bit better here. We dropped from paying based on 20% down to 15%, and we got a bigger deduction. There's a new IBR basic difference is that your payment's based on 10% of your discretionary income only. Same with pay as you earn and revised pay as you earn. There are some differences in there and nuances we can go through, but just please note that these three plans here, the new IBR, pay as you earn, and revised pay as you earn, they all base your payments on 10% of discretionary income, and you get that deduction for 150% of poverty level. As I said, we'll see what that means when we go through a couple calculations. Not going to get into things like the subsidies and the caps on payments. Those are just a couple nuances, but this just gives you a good overview of the different plans. Now, net worth, why would I bring that up? I'm a certified financial planner. I look at comprehensive financial planning, and student loans I look at as a piece of the puzzle. I don't look at student loans in a bubble. One of my goals is to help people grow their net worth as fast as possible. So when we're looking at student loans, we have to think of, how is this going to impact our overall financial plan and our other goals? So does it make more sense to pay, let's say you owe $100,000 in student loans. Over time, does it make more sense for you to pay $150,000 total, $250,000 total, or something less than $100,000? So it's kind of a rhetorical question. Actually, it is a rhetorical question. There's only one answer. You just want to pay the least amount possible if you're trying to grow your net worth, and we'll take a look and see what that looks like. These are some of the advantages of the plan we're going to lay out coming up. Just keep in mind any plans I lay out here, they're just for educational purposes. They are in no means related to any particular individuals. This is just a scenario that I came up with. So some of the things we'll look at is try to free up cash flow for you, supercharge your retirement savings, try to see if you can qualify for a tax-free loan forgiveness, and see if there's a way to improve your net worth much faster. One consideration to look at is getting married. Are you going to get married? How is that going to impact your student loans? So if you are getting married or you are married, you have to look at a few factors. So do you both have student loans? If so, what types of loans? Second consideration, should you file married filing separate or married filing joint? Do you live in a community property state? Can you work towards public service loan forgiveness? Keep in mind the MFS versus MFJ, that's a calculation you should speak to your tax professional about before making any decisions. But I'm just going to walk you through and show you the difference from a student loan standpoint. I'm not going to give you a calculation on tax filing status. I have prepared tax returns for the last couple of years. Last year, I only did tax returns for clients with student loans. So I do have some familiarity in this arena, but like I said, I'm not offering any specific advice here today. This is just for educational purposes. The third factor is buying a house. If you get married, typically you're going to buy a place, and how would student loans affect that? A couple of quick things to look at is when buying a house and you have student loans, there are a few different ways that lending institutions will factor in your student loans. First of all, some institutions and banks will just omit student loans from the debt to income calculations, and that's beneficial to the borrower. Other banks will look at your student loans and use your monthly payment to calculate your debt to income ratios. And that's important. It depends on what type of mortgage you're applying for, whether you're applying for a conventional mortgage or you're applying for an FHA loan, for example. There are different debt to income ratio thresholds that you have to be under to qualify for these loans. So if you have, let's say you have $100,000 in student loans and your monthly payment is based on income, let's say it was $500 a month before we moved into the $0 payments back in March of 2020. If that were the case right now, when a bank went to run your student loan payment, they would see a $0 payment right now. Like I said, each bank is going to be different, but some banks may look at that and say, well, we need to figure something out for that payment. What they will typically do is they'll take 1% of your outstanding loan balance and assume that that's your monthly payment. So if you have $100,000 in student loans, 1% is $1,000. They'll assume your monthly payment is $1,000 and use that in your debt to income ratio. And we can see where if your actual payment was only $500, this could throw things off. It could cause you to not qualify for the mortgage or not qualify for as beneficial of a rate as possible. So you have to be aware of how banks are looking at these things when you're going to buy a house. So as I mentioned, there are different factors to consider. Credit score is very important. This is something I work with clients to do, is to improve credit score whenever possible, just so you always qualify for the most beneficial rate possible. But I did some math and looked at even today's low interest rate environment. Improving your credit score from let's say about 670 to about 800. These are just ballpark figures. You could save $60,000 on a $300,000 30-year mortgage. So that's pretty substantial. If you don't think it's worth putting in the time and effort to bump up your credit score, this is the math that says that's not the correct thinking. This shows you that there is a solid reason to work on your credit score, be mindful of what you're doing with your credit, take a look at your credit report, and make sure you're on track. So it does kind of give us credence to the fact that it's beneficial to improve your credit score before applying for a mortgage. And I'll show you the math here in a second. We also have to know the loan types, associated down payment, and DTI, which is debt to income ratios, when applying for a mortgage. If you do want to see how these rates shake out based on your credit score, you can look at myfico.com. It gives you a good idea of what rate you might qualify for, what the average rates are based on credit score. Here's the calculations. If we were taking out a $300,000 mortgage with a credit score of 650 in today's interest rates, you would have a payment of $1,335 a month, and you would pay $180,000 in interest over the life of that loan. If, however, your credit score was 760, your payment would only be $1,168, so you're saving about $150 a month. And the interest over the life of the loan, so over a 30-year period, would be $120,000. That's a savings right there of $60,000. So like I said, rough estimate using rough numbers, no individual person being singled out here. This is just an example I came up with, but shows you the power of working on your credit score. We're going to look at a case study here. This is a case study I just created, a fictional study of a doctor with family income of $200,000, or say their debt's $300,000. Look at the different factors of if they're married or filing separate, looking at retirement plans, and possibility of public service loan forgiveness. In this example, we have the doctor is married with 2 kids. She earns $150,000. Her spouse earns $50,000. The spouse has no student loans, and we're going to assume that the doctor qualifies for pay-as-you-earn, new IBR, or revised pay-as-you-earn. Here are the calculations when we run through what someone's income is and how do we get to what their monthly payment will be. For income, we're always talking about adjusted gross income in these examples. The adjusted gross income of the combined husband and wife is $200,000. They're married, filing joint in this scenario. Being married and having 2 kids allows you a deduction of $24,000. That's when we take all the poverty level calculations into account, but you get 150% of that. So you get a deduction for $36,000. Taking that from your adjusted gross income brings us to what's termed discretionary income. This brings discretionary income to $164,000. Being on any one of these 3 payment plans, as we mentioned, will assess you at 10% of your discretionary income. Therefore, your annual payment is here, and your monthly payment would be $1,367. What happens now if we could potentially reduce the AGI number here? How do we reduce it, first of all, and what would that look like? In my scenario, I'm going to assume that the doctor has a 403B and a 457, which is a deferred comp plan. We don't see this every time. Sometimes people just have one retirement plan, so you may just have a 403B. Just so you know, in 2021, the maximum allowed contribution if you're under 50 was $19,500. So if this doctor contributed $19,500 to each of these plans, that would be $39,000. These are tax deferred contributions, so we're not assuming any kind of a Roth contribution to anything. So on a tax deferred basis, we take the $39,000, subtract that from your AGI. You also subtract your poverty level times 150%, single or married, it doesn't matter here. Brings your discretionary income down to $125,000, which brings your payment down to $1,042. So here we're maximizing, supercharging our retirement savings by putting $39,000 per year in there. At the end of 10 years, you'd have $390,000 contributed. I'm not going to speak to what returns might look like in the market. That's beyond the scope of this discussion. But you can see how your retirement savings would be supercharged in this scenario, as opposed to the original scenario, which assumed no retirement savings at all. And we're also saving a few $100s a month on student loans. Now, what happens here if the doctor decides to file married filing separate? As I said, I'm not going to speak about what that does from a tax liability standpoint. If you go in and talk to your tax preparer and you mention that you want to file married filing separate, I'd say 9 times out of 10, the tax preparer is going to say, we're not doing that. They may not understand how this can affect your student loan payments. Their job, and I've been in this position, their job is to provide you the filing status that affords you the lowest tax liability possible. Most cases, when you're married, it's married filing joint. So just beware if you go speak to anyone, tax professional about this, you're going to have to give them some additional information and say, hey, what if we filed married filing separate? And if we could save X amount of dollars on our student loan payment per month or per year, how would that work out? And is this beneficial? Now, then you can have the discussion with that tax professional and see if that's beneficial. I'm always happy to help you, quarterback that conversation if you need to. I can, sit in between you and your tax professional and kind of, give them some of the language that might, help things move along a little faster. But in this case, as we see, the doctor's income is $150,000. As long as she's not on revised pay as you earn, she will only count her income in the adjusted gross income calculation. So we see we've eliminated $50,000 of AGI right there. Here we're eliminating another, or reducing it by another $39,000 by contributing to her retirement plans. Still take that same deduction for the family and the poverty level. She's still married. And that brings the discretionary income down to $75,000, which now brings our monthly payment down to $625. So we've cut our payment in half now by making some of these moves. Now we have to see if married filing separate makes sense, but we're saving $600, almost $700 a month, I would say. So $8,400 per year. I think that's a substantial savings. Now, a couple of things to be aware of, though. We do have, now in 2021 here and going forward, we have an enhanced child tax care credit that can be beneficial, and enhanced dependent care credit. So you lose the ability to claim some of these when you file married filing separate. You also lose other things like Roth contributions are altered. Your adjusted gross income threshold becomes very low if you do file married filing separate. So there are some things to be aware of when you do move to that filing status that you have to talk to a tax professional about. So always compare your tax liabilities in these cases and make sure you're comparing apples to apples. This is just a scenario to show you how we can potentially reduce that monthly student loan payment. And we're just considering on this demonstration here for the student loan side of things today. Now, there's additional ways we can reduce that AGI. So if you are in a federal student loan, if you're in an income-based repayment plan, your goal is potentially to pay the least amount possible, but your goal may be to pay the least amount possible on a monthly basis. So if you want to continue to reduce that monthly basis payment, there are additional steps we can take. So as we saw, we took our AGI, we subtracted our 401k, our 403b, our tax deferred retirement plan contributions are deducted. There are other things. What else can you deduct from that AGI to get to discretionary income and reduce that? So HSA, if you have a high deductible health plan, and you have to look up the definition of high deductible health plan, it's typically a plan that has a deductible of at least $1,400. You have to look and see that will change every year and a certain out-of-pocket threshold. But if you qualify for that and you can have an HSA, that the contribution limit was about $7,200 for 2021 for a family. So you could make that contribution as well and reduce your AGI. The other thing we can do is we can take advantage of a loan repayment assistance program. This is something not many people are familiar with. This was in Section 2206 of the CARES Act. It was based on a Section 127 tuition reimbursement plan. So probably boring you with all the details. Bottom line, this is another way to reduce your income by another $5,250 a year. Additionally, this can help you save taxes on that $5,250. So if your employer decides to put this into place, they can pay you $5,250 tax-free that's going toward your student loans. That'll reduce your AGI, which reduces your monthly student loan payment. And further, you don't pay tax on that $5,250. So you're not paying any tax there. Your employer's not paying FICA tax on the $5,250. So it's a win-win. There's no requirement to make there's no plan that has to be paid for. You just have to put a written plan in place. I do have an educational piece that is a template for a plan like this that should be reviewed by an attorney and have an attorney actually drop a legal document for you if you wanted to put a plan like this in place. I'm not an attorney. I don't drop legal documents. I just have something to work as a guide for you if it's something you're interested in. This benefit, though, the Loan Repayment Assistance Program has been extended through the 2021 Consolidated Appropriations Act until 2025. So why do we care about things like this? What if we're their employer? If we're looking to attract and retain more employees, I think this is something that can really help. We're offering something additional to our employees without spending any more money out of our own pockets, which I think that's a win-win. If you want to, if you disagree, that's fine. I'm just throwing this out there as something that can help. I do know that there are surveys out there where companies like Abbott Labs have asked, potential employees of other companies or potential college graduates, how likely they would be to offer a job or accept a job if it had student loan guidance or student loan repayment provisions included with that job offer. I believe it was 7 out of 10 employees said that, or recent graduates said that they would accept a job like that. 6 out of 10 said they would change jobs if a company offered that. So it's just something that there has been some research out there that shows that these are things that could be beneficial to you as an employer or an employee. So we're looking at the benefits of the plan that we laid out. We talked about improved cash flow, supercharging retirement. One thing we have not gotten to yet is tax-free forgiveness. So on the 5 different income-based repayment plans, there are various terms of those plans. And at the end of the term, any loan balance remaining is forgiven in any of those plans. So that forgiveness is tax-free, quote unquote. There's a couple of different loopholes here on that one. Currently, the current legislation right now is that all student loan forgiveness will be tax-free for the next 5 years. That won't impact a lot of people on these loan repayment plans or on the income-driven repayment plans. Most of those borrowers won't have loan forgiveness coming up for another few years after that. But there are some people that started early on these plans and they may receive forgiveness. I think one of the reasons that this plan is in place now is in case there is any loan forgiveness offered of, let's say $5,000 or $10,000 of student loan debt is forgiven. The additional benefit will be that forgiveness will not be taxable. So that's something we're keeping an eye out for to see how much might be forgiven, who might qualify for that forgiveness. And, we can see already that shouldn't be taxable as of now. But when we project forward, when we look at our student loans, currently on the current trajectory, if you're looking at a plan that is 20 or 25 years long on any of the income-driven repayment plans, that's the standard length of term. But in 20 years, your loan balance could continue to grow if your student loan payments are low enough that you're not even paying enough to cover the interest on the loan. So let's say you're accruing $1,000 a month in interest and you're only paying $800 a month. If your loan balance is $100,000 now, in 20 years, that loan balance could be as high as $200,000 or more. So we have to plan for that potential forgiveness and the potential taxation of that forgiveness. So if $200,000 was forgiven in, let's say it's in 2041, that's $200,000 in ordinary income to you in that year as the rules stand right now, as the legislation stands right now. So we have to be ready to prepare to save for that money and have that money to cover that tax liability in the future. So these are things we're keeping an eye on. There are other plans in place and things in the works right now for student loans. We do have a newsletter we send out on a monthly basis right now, but we send that out with updates on student loans. If you're interested, you can visit our website. It's right here. You can visit the website, sign up for our newsletter, and stay on top of all the latest legislation. One of the more recent discussions has been around creating a new income-driven repayment plan that might only charge 5% of discretionary income. There's also plans in place right now, and we talked about forgiveness. We didn't delve into taxable forgiveness versus non-taxable forgiveness too much, but one of the main ways to receive forgiveness on a non-taxable way is public service loan forgiveness. There's actually been a lot of pushback on that program because about 99% of the people that applied for that plan were denied the benefits that they thought they were entitled to. So there have been some revisions lately to public service loan forgiveness. So if you're in a position where you've made payments for any period of time since 2007, and you've worked for a qualifying employer, which is typically a government agency, which could be a federal, state, local agency, or a nonprofit such as a 501c3, you may be able to apply those payments retroactively now. You can look back and apply those payments towards public service loan forgiveness, and you can receive credit for even the $0 payments during COVID. those payments count towards public service loan forgiveness. Even though they were $0 payments, they still count as a payment. So that can be very beneficial. I encourage you to go out there, and if you're going to do this on your own, read more about the public service loan forgiveness waiver. There is a time constraint on when to apply for that program, and I wouldn't want you to miss out on that. Those are just things we kind of keep an eye on here, and we'll keep you posted on anything else that happens new in student loans as we learn about it. But if you go through this, I hope you found this informational. I hope you found this educational, and it can help you navigate your student loan debt a little bit better. If you feel you need additional help, you can call my office. You can go on my website, schedule a free consultation. There's no strings attached, no charge. I will honestly tell you, if I don't think I can help you with your student loans, I will tell you there's no point in hiring me. I can't do anything for you. I've done that. I'll tell you, in the last 3 years I've been doing this, there's only been, I think, one case where I sat with someone and said, I really don't think there's any benefit here that I can add. You're already doing everything possible that you can to, maximize your efficiency with student loans. So, I'm always happy to help and have that free conversation. And, I look forward to hearing from you, and, hopefully you go sign up for that newsletter. And, if you're going to work on student loans, keep working, but understand repayments scheduled to start as of right now, February 2nd, 2022. Just be ready to, have your plan in place by then. And like I said, look to work with me, or look for another CSLP to get some good advice. Thanks.